Welcome to Get Well Skills, your premier destination for mastering crypto futures trading strategies. We simplify the complexities of futures trading, offering expert insights, practical tips, and proven techniques to navigate volatile markets. From scalping to hedging, join us to elevate your trading skills and achieve success in the dynamic crypto futures space. Disclaimer: crypto futures trading involves high risk and is not suitable for all investors. Past performance is not indicative of future results. Always conduct thorough research and consult a financial advisor before trading. Get Well Skills provides educational content, not financial advice. Trade responsibly, as losses may exceed initial investments. Crypto futures trading involves speculating on the future price of cryptocurrencies through contracts, offering opportunities for leverage, hedging, and profiting in both rising and falling markets. Below are some effective strategies for crypto futures trading, tailored to different risk profiles and market conditions, along with key considerations for implementation. These strategies are derived from established trading practices and insights from various sources. Key crypto futures trading strategies: long and short trading. Description: involves betting on price movements by taking a long position, buying, expecting the price to rise, or a short position, selling, expecting the price to fall. How to implement: use technical analysis, for example, moving averages or RSI, to identify trends and entry and exit points. For example, a golden cross, short-term MAC crossing above long-term MAC, may signal a long position, while a death cross indicates a short position. Set stop-loss orders to limit potential losses and take profit orders to secure gains. Best for traders comfortable with leverage and market volatility who can monitor positions closely. Risks: high leverage can amplify losses, especially in crypto volatile markets. Risk management is critical. Example: if you believe Bitcoin will rise from $60,000 to $65,000, buy a futures contract at $60,000. If the price hits $65,000, your profit is the difference, minus fees. Conversely, short if you predict a drop. Hedging. Description: protects against price volatility by taking an opposite position in the futures market to offset potential losses in spot holdings. How to implement: if you own one BTC at $30,000, sell a Bitcoin futures contract at the same price. If the price drops to $28,000, the $2,000 loss in the spot market is offset by a $2,000 gain in the futures market. Use perpetual futures for flexibility, as they lack an expiration date and track spot prices closely via funding rates. Best for risk-averse traders or long-term holders looking to protect investments. Risks: hedging may limit upside potential if the market moves favorably, and transaction costs can add up. Example: a trader holding Ethereum can short ETH futures to mitigate losses during a bearish market phase. Scalping. Description: is a high-frequency strategy where traders execute multiple trades daily to profit from small price movements. How to implement: focus on short time frames, 1 to 5 minute charts, using indicators like Bollinger Bands or RSI to identify quick entry and exit points. Use low leverage, for example 3 to 10x, to reduce liquidation risk and close trades within 1 to 4 hours. Choose highly liquid assets like Bitcoin or Ethereum to minimize slippage. Best for experienced traders with time to monitor markets closely and execute rapid trades. Risks: high transaction fees can erode profits, and emotional trading can lead to losses. Strict discipline is required. Example: buy a BTC futures contract at $60,100 and sell at $60,200 within minutes, capturing small gains repeatedly. Swing trading involves holding positions for days or weeks to capitalize on medium-term price trends. How to implement: analyze price trends using technical indicators like moving averages, Fibonacci retracement, or MACD to identify entry and exit points. Combine with fundamental analysis, for example, news on blockchain upgrades or regulations, to confirm trends. Use stop-loss orders to protect against sudden reversals. Best for traders who prefer a less intensive approach than day trading but can still monitor markets periodically. Risks: overnight price swings in the 24/7 crypto market can lead to unexpected losses. Example: enter a long position on ETH futures after a breakout above a resistance level and hold for a week to capture a 5 to 10% move.
Arbitrage. Description:
exploiting price differences between exchanges or between spot and futures markets to secure risk-free profits. How to implement? Buy a cryptocurrency on one exchange where the price is lower. For example, Bitcoin at $59,800 on Kraken, and sell a futures contract on another where the price is higher. For example, $60,000 on Binance. Use automated tools or bots to detect and act on price discrepancies quickly. Risk management? Account for transaction fees and slippage, which can erode profits. Ensure high liquidity to execute trades efficiently. Suitability? Best for advanced traders with access to multiple exchanges and fast execution systems. Spread trading. Description: profiting from the price difference, spread, between two related futures contracts, such as different expiration dates, calendar spread, or different assets, inter-market spread. How to implement? For a calendar spread, go long on a Bitcoin futures contract expiring in April 2026 and short on one expiring in March 2026, betting on the spread widening. For an intermarket spread, go long on Bitcoin futures and short on Ethereum futures if you expect Bitcoin to outperform. Risk management. Monitor correlations between contracts and use stop losses to limit losses if the spread moves unexpectedly. Suitability. Advanced strategy for traders familiar with market correlations. Trend following. Description: trading in the direction of the prevailing market trend using technical indicators to confirm momentum. How to implement? Use indicators like the 50-day and 200-day moving averages to confirm uptrends or downtrends. Enter a long position during an uptrend, for example, when Bitcoin breaks above a key resistance level, or a short position in a downtrend. Risk management? Use trailing stop losses to lock in profits as the trend continues. Avoid trading against strong trends to minimize losses. Suitability. Suitable for mid to long-term traders comfortable with technical analysis. News-based trading. Capitalizing on price volatility triggered by significant news events, such as regulatory announcements or major exchange listings. How to implement? Monitor news sources and X posts for real-time updates on crypto events, like ETF approvals, hacks, or protocol upgrades. Use limit or stop orders to automate trades when prices hit specific levels post-news. Risk management? Act quickly to avoid being caught in volatile swings. Verify news sources to avoid reacting to rumors. Suitability. Best for traders who stay updated on market news and can act swiftly. Risk management techniques. Stop loss and take profit orders. Automatically close trades at predefined loss or profit levels to manage risk and secure gains. Leverage control. Use low leverage, for example 3 to 10x, to reduce liquidation risk, especially for beginners. High leverage, 20 plus, amplifies gains and losses. Position sizing. Risk only 1 to 2% of your capital per trade to withstand losses. Diversification. Trade multiple cryptocurrencies, ETC, ETH, SOL, to spread risk. Monitor funding rates. For perpetual futures, understand funding rates to manage costs, as they can impact profitability. Backtesting. Test strategies on historical data to ensure effectiveness before live trading. Choosing a platform. Select a reputable futures trading platform with high liquidity, low fees, and robust security. Top platforms in 2025 include Binance, high trading volume, supports numerous futures contracts, and offers leverage up to 125x. Kraken, known for security and regulatory compliance, ideal for U.S. traders. Bybit, user-friendly for beginners, with high liquidity for altcoin futures. OKEX, offers flexible strategies and perpetual futures with competitive fees. Deribit, specializes in Bitcoin and Ethereum futures with low fees. Key considerations. Volatility. Crypto markets are highly volatile, increasing both profit potential and risk. Always use risk management tools. Leverage risks. Leverage amplifies gains but also increases the risk of liquidation. Start with low leverage if new to futures. Regulatory compliance. Ensure your chosen platform complies with local regulations, like KYC in India. Continuous learning. Stay updated on market trends, news, and technical analysis to refine strategies. Final tips. Start small to gain experience without risking significant capital. Combine technical analysis, for example, RSI, moving averages, with fundamental analysis, for example, project developments, market sentiment, for informed decisions. Avoid emotional trading by sticking to a predefined plan. For real-time sentiment, monitor X posts from trusted sources